Welcome to Markets Now. I'm Michelle Rook with Darren Newsom, Senior Market Analyst with Bar Chart. And we are seeing some mixed trade in grain and livestock futures already this morning. And Darren, let's unpack this. First of all, corn market, a little higher this morning. We saw the bull spreads working yesterday. Are we seeing underlying demand, or what's kind of driving that market this morning? Because exports were kind of within ranges this morning.
Yeah, that's a great question, Michelle. As I talked about in Wednesday's afternoon commentary and again Thursday morning, it's really hard. I mean, we could make so many different arguments for the rally in old crop corn. Was it driven by commercial buying? The May July future spread, at least for Wednesday, would certainly indicate that. But then we can apply, the one-day wisdom that tells us one day does not a trend make. So again, let's watch to see what happens here on Thursday. But I mean, if we just look at that spread, it would seem to indicate there's some commercial support. We've seen basis firming, but it's still weak. So we know historically national average basis is still running below or near or below its previous 5-year low weekly closes. If we just look at the cash index, we know that we've got ample supplies in relation to demand. So it's hard to make anything but a neutral at best argument fundamentally for corn, but here we are, with a little bit of a rally going in the old crop. Is it funds? And if it is funds, why are they interested in the May contract? Because they already hold in that long, and we're going to see the roll from May to July here in the not too distant future. So again, corn is an interesting market at this point. And we'll see what happens. And as you said, we saw export sales. Now these were as of a week ago. And what I find interesting is that if we look at total shipments and we project that out using averages, and again, this is all just based on averages, through the end of the marketing year, the pace projection actually declined. Again, we've seen a consistent decline in this pace projection since the week before the U.S. presidential election, the first week of November 2024. So I think it's very telling about demand for U.S. corn, and the fact that, yes, there was some front loading, but we just continue to see that erode away little by little each week.
Yeah, we had a very strong ethanol number yesterday. Of course, that was as of last week, so maybe that played a little bit of a role here. But when we talk about spreads, okay, bull spreads were working. We've also seen a lot of spread action between corn and soybeans on any given day. And so today, corn's up, soybeans down. So there's likely some spread activity going on between the two again, isn't there?
Yeah, there sure could be. And there's so many interesting differences, in what's going on with May and corn. Number one, a good friend of mine, pointed out the volatility difference. And corn is so much more volatile. If we look at implied volatility, if we look at any volatility reading that we want to see, that we want to look at, I mean, corn is much more volatile. And usually that would suggest that funds and long-term investors may be wanting to go somewhere else, find a little less volatile market to park some investment money. And soybeans is low, but yet here we see a net short futures position that probably increased this past week with the support again coming from the commercial side. But why? We're not seeing a big upswing in demand. So yeah, I do think there's a lot of spreading going on between the corn and soybeans. We've got different fundamental situations for both old crop, new crop, both markets. And again, I think volatility has to be coming into play, but it would certainly seem to indicate possibly the opposite direction from what we're seeing.
Yeah. And soybeans, you got to believe there's still some tariff fear there, isn't there?
Yeah, and this is an interesting point. I mean, there's nothing new on the tariff front. I mean, we've been in a trade war since 2018. We basically shot ourselves in the foot, took ourselves out of the global demand game back in 2018. So that hasn't changed. What's changed, and I think one of the reasons why we're seeing increased volatility in corn, is because all of the focus is on taking the U.S. out of the global corn game now.
Yeah.
We've already done it to soybeans. Now we're focusing on making the U.S. a secondary player in the corn market. Will it happen? And so I think that's where a lot of the volatility is coming from.
Right. Okay, the wheat market had put in some weather premium, but with the snow that moved through, it looks like we're taking weather premium back out. Or is the lower price action this morning these poor exports that we saw?
What I would lean towards is that we saw, the funds and the algorithms react to the forecasts and actual occurrences of freezing temperatures. But What was interesting to me is that most of it came with buying in the nearby May contract. And again, it doesn't make any sense for those who understand the wheat market that it's actually the new crop July and September contracts where that would be most affected by weather at this point. As the winter crops come out of dormancy and these sorts of things. So, when we saw the markets rally, both the winter markets rally Monday and Tuesday, Wednesday, all of a sudden we saw both markets hit by strong commercial selling. And then we did see some good moisture dumped, in parts of the Southern Plains, parts of the Midwest. And so certainly that's a bearish indicator. And again, speaking of bearish fundamentals, if we look at those July, September future spreads for both markets, both winter markets, they've been incredibly bearish for quite some time. As for the weekly export sales and shipments, again, these were for a week ago. And so we knew that, we could see by the future spreads, we could see by the cash indexes that, we weren't seeing an increase in demand by any stretch of the imagination. And so the fact that these numbers came out and we saw a good deal, mostly weekly cancellations for all wheat, again, not a huge surprise, but certainly fitting with the bearishness that we see across the board in our fundamental reads.
Right. And I think we're back below some of these key moving averages again here this morning after trying to get above those areas earlier in the week. So let's talk about from a broader context. First of all, we did not see the Fed raise interest rates yesterday, yet Fed Chair Jerome Powell talked many, many times about the uncertainty moving ahead. And especially, I'm sure that's because of tariffs. How do you see the market's perception of what's going on there?
You're absolutely right, Michelle. If there was a drinking game attached to yesterday's announcement, and the key word had been uncertainty, folks would have had quite a buzz at
Right.
the
I was
end
going
of,
to
of
say
the end of
you'd
the
have been
meeting.
drunk. So
Yeah. And really, this just again fits with what the market's showing us. Most importantly, gold. We've got the cash index and futures all above $3,000 per ounce, and investors are not afraid of this market. Now, when I say investors, I'm not talking about those who are betting on the market continuing to go higher, but rather those who are using gold as a hedge against their other investments. So this is what I find interesting. If we look at the CFTC commitments traders reports, futures only, and we see that the net long futures position in gold continues to come down, but yet open interest is going up, that tells us it's the hedging side. It's those who are afraid of, what Chairman Powell kept saying was uncertainty, economic uncertainty. So they're going to continue to load up on gold. Again, we talked about how difficult it is to read the situation of this time. We've got the U.S. dollar index firming despite some of the commentary within the analysis, within the announcement, saying that there's still a possibility of more than one rate cut yet here in 2024. But the markets certainly aren't indicating that. In fact, the stronger dollar would indicate that possibly an interest rate increase is coming. And why would the Fed raise rates? Basically because of the fear of inflation caused by tariffs and trade wars. I mean, that's what triggers inflation. That's what we saw back in 2018 and beyond. And that's what certainly looks like the markets are trying to tell us once again.
okay, so you've said that the only thing certain is uncertainty, but with what you just said about inflation, we know tariffs are supposed to be inflationary. So the Fed is just saying, hey, we're going to pause right now because we don't know what's going to happen and we don't want to get ahead of ourselves.
Yeah, because the official statements change every day depending on market reaction. And so again, this is what we saw in the previous time with this administration is everything is based on market reaction or done to create a market reaction, which is a little more unsettling if we stop and think about it. So, tariffs will be on, tariffs will be off, tariffs will be put back in place, they'll be delayed, they'll be on and on, never ending. And so I think that's where the uncertainty comes from. So that's where we have to rely on what the market's telling us. Yes, we will see day-to-day swings, but what are the long-term trends? What's the long-term trend of gold? Not corn, but the U.S. dollar index, U.S. stock indexes, these sorts of things. So we have to be. Those I think will be our better indicators than trying to make any sense whatsoever from what comes from the administration day to day when it comes to trade.
Right. But if we do get inflation, obviously the Fed may have to step in here and change course a bit. Okay, so the cattle market made some new highs again here this morning. Contract highs in the feeders have continued. new highs for the move here in the live cattle, and we're very close to the contract highs there as well. Weather, do you think that was part of the push here? And can we keep going, or are we going to see some correction before we get into this cattle on feed report tomorrow?
To begin with, the cattle on feed was as of March 1, and we already know what happened during February. We can look back at the spreads. All the spreads weakened, as far the majority of the spreads weakened during February. So that tells us, that the supply and demand situation through February seemed to loosen up a bit. But here in March, it's a different story. And so, I think most rational folks will set aside the outdated numbers. They're fine. You can put them in your logbook, you can put them in your Excel sheet, whatever, and then move forward and continue to look at what's actually going on. And here's where cattle, you can call it confusing, you can call it interesting, you can call it whatever you'd like, but we're seeing a big divergence in the boxed beef markets. We're seeing, as you mentioned, the futures markets here in March going to new contract highs. We're seeing future spreads again indicating strong or renewed commercial buying interest, and we're seeing the cash market firm again. So if we're painting this picture, and so it's so easy to do of questionable or uncertain economic times here in the US, and we look over at the cattle market, it certainly seems to be indicating that it is still bullish. And what will be more interesting as we move forward is if this divergence between cattle, any aspect of the cattle market, and the US stock indexes continues to grow. Those market sectors tend to move together. So when they start to diverge, it gets more interesting.
Yeah, and they have been diverging. We've been really resilient in this cattle market despite this big correction that we have had in the stock market. You've got choice boxes, which were up over $6 yesterday, but with only a 96,000 head slaughter figure, is that artificial at this point?
Yeah, that was interesting, and I appreciate you updating me on that. That was interesting. So, and it all kind of fits together if we want to make that argument. Weather certainly played a role, but I'm going to go back to my rule 4A that says a market that can't go down won't go down. And for so long, for the last number of months, it looked like the cattle market was doing everything, putting itself in position to do nothing but go down, and it didn't. It dropped a little bit, but came storming back. And we may not know all the reasons why. We could try to put all these pieces together, but the bottom line is it didn't go down, and now it's making new highs. And as a good friend likes to remind me, when you're making new highs, it isn't necessarily bearish.
That's right. We need to put like all of your Watson points up and hit those as we talk about them. They're always interesting. All right, thanks, Darren Newsom with bar chart, and that is Markets Now.